everyone, my name is Levina Sania Anamlaka and my normal metric is 20DAC25F1029. We are from Group 8 and today we will present on accounting for provisions and contingent liabilities and assets under MFRS 137. Our presentation are first, to explain the nature of provision and contingent items. Second, to describe recognition and measurement. Lastly, to present how these items are disclosed in financial statement. Before we look at the definition on the slide, we must understand the nature of this standard. In accounting, we follow the concept of prudence. This means we are conscious. We don't want to overstate our asset or understate our liabilities. MFRS 137 provides the rules for reporting uncertain items to ensure the financial statements are transparent and honest. First, let's start with the definition. A provision is a liability of uncertain timing or amount. For example, warranty expenses. A contingent liability is a possible obligation that depends on future event. A contingent asset is a possible asset that arises from past event but depends on future outcomes. As you can see on the slide, a provision is liability of uncertain timing or amount. But what does uncertain really mean? It means we know we have to pay, but we are waiting for the final bills. For example, in a warranty expenses, we know customer will bring back broken product. We must record this obligation now to follow the matching principle even if the repair happen next month. Moving to contingent liabilities, the keyword here is possible. Unlike a provisions, there is not a defended debt yet. It depends on a future event, like court case. If our lawyer said there is only a 30% chance we will lose, it's contingent. We don't put in our main account because it might never happen, but we must tell the truth in the note to the accounts. Finally, a contingent asset is a potential gain, but be careful. In accounting, we are prudent. We never record a maybe asset in our balance sheet because we don't want mislead investors into thinking the company has more money than it really does. We only mention it if the inflow of money probable. Now, I will pass to my friend for further explanation.
I will explain the nature of provisions and contingent items under MFRS 137. First, a provision is recognized when three important conditions are met. Number 1, there must be a present obligation. Number 2, there must be a probable outflow of economic resources. And number 3, the amount can be estimated reliably. If all these conditions are satisfied, the company must record provisions in the financial statements. For example, warranty obligations. Next is contingent liability. A contingent liability is different from a provisions because it is uncertain and does not meet the recognition criteria. Therefore, contingent liabilities are not recorded in the accounts. Instead, they are only disclosed in the notes to the financial statements. An example is a lawsuit where the company is not sure whether it will lose or win the case. Last is contingent asset. A contingent asset is also uncertain and cannot be recognized immediately. It is only disclosed when the inflow of economic benefits is probable. However, it will only be recognized as an asset when the inflow becomes almost certain. Now, I will pass the presentation to the next presenter to explain recognitions and measurements.
A provision is recognized when three conditions are met. First, there is a present obligation, legal or constructive. Second, it is probable that payment will be required. Third, the amount can be estimated reliably. For measurement, provisions are measured at the best estimate, then based on expected costs, and lastly adjusted for risks and uncertainties. For example, if warranty cost is estimated at 10,000 ringgit, it should be recorded as a provision. For contingent liabilities, they are not recognized and only disclosed in the notes. For contingent asset, it is not recognized unless almost certain. If almost certain, it will be recognized as an asset.
Thank you. Now I will explain how provision, contingent liabilities and contingent assets are presented and disclosed in financial statement. First, for provision. Provision are recorded in the statement of financial position as a liability because they represent a present obligation. They are classified as either current or non-current liabilities, depending on when the payment is expected to be made. In terms of disclosure, companies must provide additional information in the notes to the financial statements. This includes the nature of the provision, meaning what the provision is for, the movement during the year such as addition or amount used, and the estimate amount involved. This helps users understand the impact and uncertainty of the provision. Next, for contingent liabilities. Contingent liabilities are not recorded in the financial statement because they are uncertain and may not result in an actual obligation. However, they must still be disclosed in the notes. The disclosure usually includes a description of the situation and the possible financial effect if it can be estimated. For example, a company may be involved in a lawsuit, but the outcome is still uncertain. Lastly, for the contingent assets are also not recognized in the accounts. They are only disclosed in the notes when there is a probable inflow of economic benefits. They will only be recognized as actual asset when the inflow becomes almost certain. For example, a company may expect compensation from a legal claim, but until it is confirmed, it remains a contingent asset. To illustrate, an example disclosure would be, the company is involved in a legal case and the outcome is uncertain. This shows transparency without overstating financial position. That's all from me. Now let's move to the example and conclusion.
Thank you. Let's look at a simple example. A company sells product with a 1-year warranty. Estimate cost is 5,000 ringgit. This is provision and must be recorded. If the company faces a lawsuit, if the outcome is uncertain, it is a contingent liability. If the company expects compensation, if not certain, it's a contingent asset. What is the main difference between a provision and a contingent liability? The answer is a provision is recognized in the accounts, while a contingent liability is only disclosed in the notes. In conclusion, MFRS 137 ensures the company report liabilities and assets accurately and transparently. Provisions are recognized when criteria are met, where contingent items depends on the level of certainty. Thank you.
321の合図でビルは回り出してカートがかかるまであと何秒演技没